Good day all. Ira Epstein with your agriculture update for this Thursday, the 28th of March, 2019, and we're about 2:20 p.m. Central Daylight Time. I wanted to wait and get into the marketplace, the pig crop report, and we'll talk about that in a moment. Remember that tomorrow for you grain traders, what you have is you're going to have the USDA supply-demand report and the acreage numbers. So at 11 in the morning, that'll come out. As I just said, what we had today, let me step this way, were our pigs and quarterly headline recaps. And as you can see, the expectations and the numbers are all the same, from the all hogs kept for breeding, kept for marketing. The pig crops varied, but not by enough to mean anything. That's how I look at it. So as I'm looking at the market and I go back in time, it appears that the farmers' intentions, when you take a look at the farrowing intents, are down a little bit for the March-May period and then for the June-August period. But everything else in the report, nah, I wouldn't think the market moves one way or the other basis that. So now we go to the soybean market, and the market for the week, as you can see, is down about 14 cents. The market, if it closed like this, would be back under the 18-week average of closes, given the market downside bias, but we're not at the close. When you get an inside day in front of a report, often it's a pause sign. Just keep that in the back of your mind. So you've had a market that's been thrusting down, and as you can see, you've got the higher high, lower low. Now with that inside day, if you take out this 886 level, what happens is you could end up with lower highs, lower lows. So be aware of that. The market is setting itself up where it could set up a downtrend. It cannot set up an uptrend out of this chart pattern. If the market were to rally, resistance I would expect to see at the 18-day average of closes. The Bollinger Band was hit yesterday, again today, and that is what is trying to support the market. But in front of a report that only has so much importance, then if you get a shock in the report, it goes one way. If the report comes out just normal, it takes back its importance in the market. In terms of momentum, you've got an oversold market that is downside targets, not trending, had a big price thrust down. I think the pros are coming out in front of the report. In the meal market, the pattern is just like these soybeans. You have the higher high, the lower low with the inside day. So should this market now break through this 303.60 level, you could end up with lower highs, lower lows, putting into play a challenge of the lower Bollinger Band in this $3 area. Let's assume the market rallies. Well, the first resistance I'd expect is right here at the 308.40 level. If it wanted to, you can even get back to 313.70. The problem is nothing on the upside creates an uptrend on this particular pattern right now. It's easy to set up the downtrend, and you're not in oversold territory. In the soybean oil, this is what I pay attention to. I have a hierarchy on charts, and the slow stochastic becomes first when it's embedded. So it doesn't matter if you're trending, not trending. This takes over, and momentum is saying attempts at rallies are failing. Now, if you lose the red line over 20, it gets back over it. It's called a K line. Then I'd look for this area to be challenged, the combination of the 100-day average and the 18. As long as it stays embedded, you can continue to run on that lower Bollinger Band number. In the corn market, you have a funny setup here. While the market's got an uptrend, higher lows, higher highs, momentum, which often leads price, is turning down. If it stays down, if you take a look right here, you've got 372 and the 18-day average is 371.5 to 3/4, right in that zone. Let's assume the market takes out 372. You could easily end up then with lower highs, lower lows, and if you close under the 18-day average, the bias would turn down, the trend would turn down. So going into the report, I'll let you flip the coin as to what's going to happen. The wheat market. The wheat market is number one, overbought. Number two, it has hit its upside target, the upper Bollinger Band, and when that occurred, it stepped out of the uptrend by breaking back the past 2 days under the previous 363. So what you did is you broke this pattern of higher lows, higher highs, right into that number in an overbought situation. The market spent no time at all trying to push the upside even higher, and it just backed off. The 18-day average could be a number the market wants to go to regroup itself. In the sugar market, the battleground is the 18-day average to the 100-day average. If this market, and by the way, the market's still very much with the swing line down, it is completely balanced out because prices are staying over the 18-day average of closes. If the market were to start down from here, this is the key number, just getting right to this day's low. And that low is 1233. If that's taken out, it's possible the market might want to run to the lower Bollinger Band. Let's assume the market wants to go up from here. If the market takes out 1273 now, what could happen is without taking out this break low of 1233, you could end up with higher lows, then a higher high, because you'd be right over the 100-day average. The Bollinger Band at 1287 would come into play in the market. So you're in an interesting zone. I don't think anybody has control of the market just yet. In the coffee, it's time after time after time, rallies to that 18-day average. What I term that line in the sand proves just too much for the market. It goes back to the lower Bollinger Band. But each time, even though the pattern is gradually working lower, it doesn't seem to thrust to the downside. It hits it, comes up, and it works itself down. Until the pattern changes, it ain't changed. So still basically one that's got downside momentum. In the cocoa market, I think it was just yesterday we were here talking, and I said the market had gone up into the resistance area here of the combination of the upper Bollinger Band, the black line, and the 100-day average. Remember the Bollinger Band, an algorithm designed to keep the market trading within it 95% of the time. And it depends if volatility has come into the market or gone out of the market as to what it does when it hits it. When you have wide swings like this, often when you hit it, it's resistance. You went back up to it today, and again, it hit that resistance and gave up a big chunk when it gave up there. But it is in an uptrend. It has hit all that resistance, and it is overbought. I'm going to say it again. I think the pros are coming out of the market there. In the cotton, to me, this was a classic day. First off, I'm looking at the market, and I'm wondering, when is everyone going to start paying attention that we have a acreage report coming out in cotton here? And I figured, okay, what's going to happen? Maybe it'll find support at the 100-day average. When that gave ground and you got under this low, a couple of things occurred. First, you had a pattern of higher lows, higher highs running the upper Bollinger Band. Number two, you have an embedded reading. This is yesterday, Wednesday. Wednesday, no sign that the embedded reading is going to give up. I'm still looking for the support there, but intraday, you took out the swing line, and when I looked at that, you already lost the embedded reading. This market, I think, is on a path to go back to that 18-day average of closes, not the 100-day. It's already gone through that. And that could be where it finds its footing and tries to figure out what next. But the bias is out of the market. The momentum is now where you're looking for price and the 18-day average to come together. The bias is up. I said that wrong. The trend is out of the market. So you no longer have the higher highs, higher lows. The bias is up because you're over the 18-day average, but momentum pointing down, and more important, you lost the embedded reading. When you lose the embedded reading, you often make a run for the closest moving average, and in this case, it's the 18. In the cattle market, remember what we said. You get these crazy V moves. And the meat markets, unlike so many other markets, they're thinner traded. I think that my own guess is the algo boys are in there, algorithm traders, and they push this thing around. Very difficult to trade, but we have a lot of people that are in the ag business, so I cover it. I don't see a trend. I see a higher high, lower low, momentum still pointing down. If they wanted to push it to the lower Bollinger Band, they easily could. Obviously, the meat market people are going to be looking to see what feed costs are, but it shouldn't have a big impact on the June cattle or the May feeder cattle. It could be further out. In the feeders, you've still got the pattern of higher lows, higher highs, so I'm looking for support right here at the 18-day average. I mean, on this break, one of the things you'll hear me say is often markets make a run to the 18-day average of closes, and that's where they decide what they're going to do. Now, if one were buying there for a position and putting a stop under the most recent low, and I would fight this is the most recent low, that's an awful lot of risk. I mean, it's over $1,000 a contract. I think the bulls, what? The bulls have control because the trend is defined by the swing line is up. The bias, the market closed today at 149.67. That's over the 18-day average, but momentum is pointing down. Pretty much a mixed bag, but in a support level. In the hog market now, what you're getting is one of these moves, a correctionary move, and look what happened. Do you see the settlements under 7,900? Unless hogs tomorrow get a move that immediately gets the slow stochastics embedding with the red line back over 80, the odds are that by midday, I think the pros will come in and start selling the market if they don't see that occurring, to try to drive it back to the 18-day average. Get the market going up from here and re-embed, then you can go up to these other numbers. Now, China bought no hogs this week, and that weighed on this market going into the pig crop report because they've been buying, and you went limit down today. So just something that you have to put your hat on as you look at these things. Let me get to where I want to be. There we are. We're going to be writing about the grain report tonight that's coming out for tomorrow. We'll be writing about the reaction to the pig crop report for certain. So for those of you that do like agriculture, I don't think you're going to find information quite like ours typically out there. We write for producers, for hedgers, for those that are using option strategies, and of course the futures. Are you a spread trader? How many people write about spreads? We do it in a number of these different markets. So if you'd like to learn more about our products, let us put it in your hand and you decide from there. It's that simple. We only give one free trial to these, so understand how that works. How do you get it? Either call us, go to our website. There's a carousel of free offers. Click on it, sign up for what you want. We'll get it in your hands. I'm Ira Epstein. You have a great day.